Hello, it's Tuesday the 6th. I'm FxPlew and this is the market brief. So we had the services PMI data out for May. That stayed pretty much around the same level as we saw in April. The good news there is that the service sector is still well into expansive territory at 55.2. This is positive given the dominance of the service sector in the wider UK economy. The bad news is that wage input costs have been growing for the past 3 months. Wage input costs add to core inflation and they will add pressure for the Bank of England to hike interest rates further. This also adds to the risk of a wage price spiral, which is where firms increase prices to make up for the increased costs. Those higher prices add to inflation, which in turn drives further demands for higher wages, and so it goes on. And the Bank of England is right to be concerned about this. That kind of thing can last quite a while and can certainly slow any fight against inflation. The next MPC meeting is in about 2 weeks' time, and so far the data out suggests that we will have another 25 basis point rate hike, and the prospects for higher rates continue to support the pound as speculation over where the rates tightening cycle will end continues. Over in the US, sentiment suggests that we'll see a pause from the Fed, or at least that they'll take a month off from any rate hikes. The rhetoric has softened as most Fed members are uncomfortable with the idea of announcing an end to rate hikes when inflation is still so far over target. And some Fed members are even uncomfortable with the idea of a pause. So, baby steps then, yeah? Let's skip a rate hike for a month or two. Try that one on for size. See what happens if we do nothing to monetary policy and give it a little time. It's a tough job as a central banker, I'm telling you. But a pause would certainly help the economy and the financial markets, for that matter, catch up with all the rate action that we've seen so far and allow any lag to play out a little. Many feel that the Fed has already gone too far and done too much for a soft landing, and that the economy is heading towards a recession later in the year. And it is easy to see why. The Fed have increased interest rates from close to 0 to 5% over the last year without any pause to take stock or gauge the effect. Or in other words, to allow any time for the lag to really play out and take effect. Meanwhile, the economy already looks pretty close to recession with no real GDP growth since the beginning of the year. So they are treading a pretty fine line between flat and negative growth. In the market, the dollar was finding support from the resolution to the debt ceiling crisis, but this could easily be running out of steam. Now the debt ceiling is old news. The dollar index fell back to the 104 level, and sterling closed around 124.40 against the dollar yesterday. We kick off this morning unchanged. We're around 124.40 against the dollar. We're about 116 against the euro, and euro dollar is around 107.25 on the open. Right, that's it from me. Have a great day.
If you do not have a clue, then just tweet through and ask FxPlew.